Hey guys, welcome back. Today we're going to do a deep dive, sort of, into 5 small cap Canadian stocks in the oil and natural gas, or oil and energy sector, that I think are worth a look. They're possibly undervalued right now given their price to value, and I see good things for them. I'm an owner of many of them. This again is not a recommendation. This is my opinion. Please don't take this as an investment recommendation. That's definitely not what it is. But I'm going to show you a little bit of a fundamental analysis I did on them and why I think they're pretty good. So the first one, Alvo Petro Energy. It has a debt ratio of 0.1. So 10% of its value, give or take, or of its valuation, is what it carries as debt. Generally speaking, anything below 0.5 is great. When you're this low at 0.10 or 0.1, fantastic. It means they carry very little debt. So an incoming recession is not going to be a big deal for them, or shouldn't be. And they have room to take on possibly more debt if they need to either create new projects or exploit new things. And interest rates, stuff like that, really shouldn't bother them. So first thing I look at, how much debt does a company have? Debt is cancer. Second thing, current ratio. And I apologize for all the jargon here. If you need some help with this, I do have a course on Investing 101 where we go over about 20 terms that are recurring in corporate finances. I'm going to try to summarize them here, but current ratio is basically how much money is coming in for the period versus how much money is going out. You can think of it as, for every dollar they spend, how much are they getting back? In the case of Alvo Petro, they are getting back $2.02. That's a really good ratio. Again, anything above 1.5 would be good here. 2 is fantastic. Their PE is at 3.99. So their price to earnings, 3.99, is really low. Definitely bargain basement in terms of value. And anything below 15, usually good place to look at. Their enterprise value to EBITDA, this one's a bit nebulous. I won't go too deep into it, but the enterprise value being the market cap to the EBITDA, which is the amount of money or earnings before taxes, interest, amortization, depreciation. Yeah, I think I said it backwards, but anyway, if you take the ratio of these two, you want to be below 7, ideally. In their case, they're at 2.12. So again, very good valuation ratio. And then a bit of a cherry on top is that their dividends is currently sitting at 18.69%. So for their price and for that dividend, and I didn't study too far into how long they've been paying this dividend, and yes, it may well drop in the future, but still, for right now, this is a very high dividend ratio payout. So if you're a dividend searcher, I would suggest investigating Alvo Petro a little bit more. All right, on to the next one. Lucero Energy, LOU, the ticker. So their debt, 0. That's fantastic. It's really hard to go bankrupt with no debt. Obviously, all the previous statements around resiliency for economic downturns, all that still applies here. Their current ratio, in their case, 3.6, so even better. Their PE, price to earnings, is at 7.39, so a bit higher, actually almost double what the previous one was, but still well below 15. Bargain basement area, good place to start. Their enterprise value to EBITDA ratio is 2.45, so almost the same, 212 from the previous one, and pretty good, well below 7. In their case, though, they do not pay a dividend, so this would be a growth play, and there's no dividend, no income coming up right away or on a recurring basis. Next one, TAL, T-A-L is a ticker, Petrotol Corp. They have a debt of 0.06, phenomenal, love seeing that. A current of 2.49, fantastic. Spend $1, you get $1.50 or $2.49 back. A PE 4.74, bargain basement zone, always like to see this. Enterprise value to EBITDA at 2.26, fantastic valuation. And a dividend of 10.39%. That's a really nice dividend spot. So you know, it's probably a touch on the high side. I assume this is because their price has been beaten up over the last couple of years, and there's likely to be some, well, in my opinion, again, these prices are going to go up for these stocks, but I think that's why the dividend ratio is high right now. Definitely a good opportunity, if you ask me. And next up, PMT, Perpetual Energy. Interesting name. Debt is at 0.33, so of the bunch, they are the highest on debt, but well below 0.5. Current ratio, 1.57. Again, pretty good. PE of 733, well below 15. Great. EV to EBITDA of 3.03, well below the 7 threshold, and you know, good spot for valuation. They, in their case, do not pay a dividend. So again, if you're looking for dividends, this is not really the one for you. This one here is more of a growth play. And then a special bonus, DJT. This one's not Canadian. I know I said Canadian at the beginning. I shouldn't have said that. It's also not in the energy area, but I'm going to include it here, and we'll see what happens. So debt for DJT, or debt ratio to DJT, is 0.02, which is really good. Debt to equity, by the way. But one big question mark here I have is, because of the GAAP accounting rules, I don't know what the equity actually is behind DJT. So if we look at it, it's possible that there's some stuff in there, some assets that aren't valuated as hard as they could be, especially when it comes to software, intellectual property, patents, stuff like that. It's a little bit weird, given that, again, Mr. Trump was just indicted of, you know, skewing numbers in New York. I have a reservation there, but still, all right, on the face of it, debt is good. Current ratio, this one here, definitely not good. 0.06. That means for every dollar DJT spends, they get 6 cents back. This is not a cash flow company. This is not doing good for at least this reporting period, and that's not what you'd want to invest in, at least not for me. This is a danger zone. EPS, in this case, I went with the earnings per share because they're in the negatives by 69 cents. So for every share you have, you lose 69 cents per year, given the current reporting period. I didn't calculate the PE because it wouldn't really make sense. But again, this is a company that loses money quarter over quarter. That doesn't mean they can't make money in the future. It just means they have to make money at some point, or they'll run out, or they'll have to go into tremendous amounts of debt to keep going. And those companies typically don't fare well because they'll either get acquired for pennies on the dollar, or they just close up shop if their valuation, the actual value of their assets, intellectual property, patents, and so on, isn't very good. Dividends, obviously, they do not pay a dividend. And then their net income is at negative 15.64 million. So, again, not a great spot for DJT. Losing money. Looking at it, I assume the people that are rushing to buy this stock are betting on Mr. Trump and not on the company itself, because definitely the math doesn't add up. The fundamental analysis of DJT does not add up to its, well, current value point or current price point and everything else around it. So anyway, that's it. 4 Canadian stocks and 1 bonus DJT fundamental analysis for today. Thanks. Oh, please subscribe.